Tax for non-residents of Canada. You are a non-resident for income tax purposes if you normally, customarily, or routinely live in another country and are not considered a resident of Canada. Do not have significant residential ties in Canada, and any of the following applies. You live outside Canada throughout the tax year. You stay in Canada for less than 183 days in the tax year. If you lived outside Canada during the tax year, and you are a government employee, a member of the Canadian Forces or their overseas school staff, or working under a Global Affairs Canada Assistance Program, see Government Employees Outside Canada for the rules that apply to you. These rules can also apply to your dependent children and other family members. As a non-resident of Canada, you are subject to Canadian income tax on most Canadian source income paid or credited to you during the year unless all or part of it is exempt under a tax treaty. Canada's income tax system uses the following two methods to calculate the tax payable on Canadian source income you receive. Method 1. Non-resident tax. Canadian financial institutions and other payers have to withhold non-resident tax at a rate of 25% on certain types of Canadian source income they pay or credit to you as a non-resident of Canada. The most common types of income that could be subject to non-resident withholding tax include interest, dividends, rental payments, pension payments, old age security pension, Canada Pension Plan or Quebec Pension Plan benefits, retiring allowances, registered retirement savings plan payments, pooled registered pension plan payments, registered retirement income fund payments, annuity payments, royalty payments. However, if there is a tax treaty between Canada and your country or region of residence, the terms of the treaty may reduce the rate of non-resident tax to be withheld on certain types of income. To find out if Canada has a tax treaty with your country or region of residence, see tax treaties. Note: generally, interest you receive, or that is credited to you, is exempt from Canadian withholding tax if the payer is dealing at arm's length with you. For more information, see definitions. For more information about rates of non-resident withholding tax for the various countries or regions that Canada has a tax treaty with, go to Non-Resident Tax Calculator, see Information Circular IC 76-12R8, applicable rate of Part 13 tax on amounts paid or credited to persons in countries with which Canada has a tax convention, or contact the CRA. Reporting income that has non-resident tax withheld. If a non-resident tax was withheld on any of the types of income listed previously in Method 1 in 2022, you do not have to report the income or tax withheld on your Canadian tax return. In general, the non-resident tax withheld is your final tax obligation to Canada on this income. However, if you receive rental income, certain pension payments, or film and video acting services income, you can choose to report these types of income on a Canadian tax return and pay tax using an alternative tax method. For more information, see elective returns. If you receive old age security pension, you may have to file the Old Age Security Return of Income, OASRI, each year. For more information, see Guide T4155, Old Age Security Return of Income, OASRI, Guide for Non-Residents. If your Canadian payer withheld more than the necessary non-resident tax. If the provisions of a tax treaty were not considered, Canadian payers may have withheld non-resident tax from tax-exempt income, or may have withheld more tax than necessary. If so, you can ask the CRA for a refund of the excess tax withheld by completing Form NR7, R, Application for Refund of Part 13 Tax Withheld. Generally, the CRA can refund excess non-resident tax withheld if you complete and send Form NR7, or no later than 2 years after the end of the calendar year that the payer sent the CRA the tax withheld. For example, if the payer sent the CRA more than the required amount of tax withheld in 2022, you have to send the CRA Form NR7, or by December 31, 2024. Depending on the tax treaty Canada has signed with your country or region of residence, the period you can get a refund for may be longer. Transfers to registered plans or funds. Certain Canadian source amounts can be transferred directly to a registered pension plan, RPP, Registered Retirement Income Fund, RRIF, Registered Retirement Savings Plan, RRSP, or Pooled Registered Pension Plan, PRPP, without having non-resident tax withheld. These amounts may include payments out of an RPP, a Deferred Profit Sharing Plan, an RRIF, an RRSP, a PRPP, or a retiring allowance. The amounts have to be transferred directly, and you must complete Form NRTA-1, Authorization for Non-Resident Tax Exemption, before the transfer can be made. For more information, contact the CRA. Method 2. Tax on taxable income. Certain types of income you earn in Canada must be reported on a Canadian tax return. The most common types of income include federal and provincial or territorial COVID-19 benefits, income from employment in Canada, income from a business carried on in Canada. The taxable part of Canadian scholarships, fellowships, bursaries, and research grants. Taxable capital gains from disposing of taxable Canadian property. You may be entitled to claim certain deductions from income to arrive at the taxable amount. You can also claim a credit for any tax withheld at source or paid on this income. If there is a tax treaty between Canada and your country or region of residence, the terms of the treaty may reduce or eliminate the tax on certain types of income. To find out if Canada has a tax treaty with your country or region of residence, see tax treaties. If it does, contact the CRA to find out if the provisions of the treaty apply. By filing the return, you determine whether you are entitled to a refund of some or all of the tax withheld, or have a balance of tax owing for the year. The CRA will issue you a notice of assessment to tell you the result.